You get to set the stage, lay out all the big themes. You have the advantage of being a bank and on the fintech side, so see it all. I just like to
Yeah,
start.
I can't decide whether I'm offended by the title or not. You and Matt Harris, I think, came up with that. So I don't want to break the bank. I want to build the bank.
Yeah, break the old banks, I guess is what you might say.
Exactly.
Can you, just to start off, give the snapshot of lead bank today, like size, activity, whatever metrics you can share so people understand the business?
Lead builds financial infrastructure. We own a bank holding company located in Kansas City, Missouri. We have 5 offices, 2 in Kansas City, which if anyone wants to visit, I highly recommend coming during Chief season. Tough end of last year, but the games are really fun. You're all welcome. And we also have offices in Sunnyvale, San Francisco, and New York City. We build bank primitives to help people embed financial services in context of where they have activities. And I bought the bank in 2022 with 3 co-founders who joined me from Square, and we've been off to the races ever since. The API primitives that we build sound like very commoditized old school banking products like issuing ACH wires, lending, accounts, real-time money movement, multinational money movement. The way we do it is in a very sophisticated API-driven way. Our clients are the who's who of consumer, fintech, e-commerce around the world.
We can get into one right away, I guess. I mean, I think stablecoins are obviously going to loom super large today.
Yeah.
We have after this Zach Abrams at Bridge. At the same time, we have legislation in Washington. I mean, my question is just, you're already supporting stablecoins. Why do you need the legislation? Or what do you see as sort of what you were sort of allowed to do versus what you will definitely be allowed to do if this passes?
Sort of allowed to do is a hard thing to do. If you're a bank, I think you have to get comfortable with the idea that you engage in activities that you are allowed to do by your regulator. I mean, I like to describe us as having an ownership stack and a liquidation preference of taxpayers in the United States, since the FDIC insures our institution. And so if we screw up, it's American taxpayers who foot the bill. Therefore, they have every right to make sure that we don't screw up and that we're good operators. And so as it relates to stablecoins and with digital asset activity, there's still a lot of uncertainty and lack of clarity about how financial institutions and how crypto companies are allowed to operate in the context of products that exist in the US financial institution. As a bank itself, there was a lack of clarity, and still is, about are we able to custody assets? Are we able to have stables and other type of digital assets as clients? And I'm sure everyone has heard the noise around debanking. I would say...
Sorry, debanking the last administration, or you think there's more debanking to come?
I think it didn't exist in reality. I think that's a fiction to some degree. We can get into that, but let me finish your prior question. So the clarity that's needed is with each of the products that have been created around Bitcoin, stablecoin, other types of digital assets, there needs to be definition around both market structure, which is a bill that has not been developed to the extent that it needs to be, but that one's coming next. And then the Genius Act, which is around the structure of stablecoins really as a payment device and how different institutions are able to custody and manage those assets.
Are there things you're not doing now that if it passed you would do? Or you think
No.
it just gives your customers more confidence?
No, I mean, I think the one thing that it's pretty explicit about is giving banks the ability to custody and also issue. And I think that could be a pretty interesting thing for the banking industry overall. I don't think it impacts our roadmap one iota.
You're not going to have your own stable coin? Or?
The Jackie coin. We might do that as a joke.
I love that that's your first. It's he names his business after himself. I'll name my coin after him myself.
So
Yeah.
ridiculous. Everyone, buy later. It's launching this afternoon. That's going to be our big announcement at the end of this discussion. No, I mean we won't change our roadmap based on the legislation. We've been working on it for a long time and have been deeply involved with Congress in the creation of the legislation and also in dealing with issues on behalf of the banking industry, including all of last week, where we try to represent banks and fintechs in a very pragmatic way at expressing what the needs are of those two industries and how they might manifest their products in the real world. And there's a big lack of clarity around what it actually means to have these products in the real world. And that could even be something like, how do you do red flags training for banks? It's one issue, but in the world of digital assets, it gets very different than it does for traditional red flags training. Or, what happens if there is a DPEG on the in a stablecoin situation? What happens in a banking context? And so, depending on what that collateral is, because right now we're just used to the topic that it's going to be pegged to USD, but that is not a legislated mandate. You don't have to have collateral that is held in the United States. And so what happens if all of a sudden you're buying stablecoins and it's held in El Salvador, for example? And if something goes wrong, how do you deal with counterparty risk? And I think some of that definition are some of the things that both banks, fintechs, and customers in general have to look at. And if Synapse Evolve was any preview of what's to come in a higher velocity around stablecoins, because I do think the uptick is going to be greater than that we've seen for a lot of other products.
You're
and I think
this,
you'll
this
hear
will
that
create
next.
a Wild West. We've seen a Wild West before. There were some problems. I wanted to ask directly, to take stock of the Synapse situation, the related sort of Evolve situation. Like, what lessons do you think this industry needs to learn from what happened with Synapse?
I think the best advice I could give is that, one, as a consumer, you have to know where your money is and what ability you have to get to it in all different kinds of stress scenarios. And even in the case of fraud, where like you're defrauded in you created your own problem as a consumer, do you even know who to call in order to get your money back? And
so this is a bit of a caveat emptor. It's like you need to know who's holding your money.
You need to know. You need to do your due diligence on understanding your own risks as a consumer. And then I'd say within the ecosystem, as a fintech, you need to know who you're partnering with and how stable they are financially and how much you trust them as an entity, because you are relying on them, and that is a very deep trusted relationship. And so I said last year, make sure you do your due diligence on any bank that you work with as a fintech. And frankly, it's any counterparty. And so you should be doing reverse due diligence on them. And I think that's really important to do as a fintech. And as a bank, I would say you need to understand your own ledgering system and your own technology. I think cyber risk is not an if, it's a when. And you need to understand how you're going to deal with that.
Could Lead have one of its customers or its partners lose track of depositors' money, or how much are you making sure that whatever your fintech partners do, where the money is?
So we have a real-time ledgering system that matches in real time. We could do real-time settlements. So that is a very different tech stack than a lot of people have in their products. And like that was my advice to the FDIC, for example. Make sure that the entities that you regulate know how to actually find the money, not only know theoretically where it is, but can they read from the systems that they should, quote, own. And I do think there's a disconnect between like, oh, they send us a file with customer data versus, oh, we know how to access it and use it, because that is the bigger risk for fintech. Like, do you know how to actually access that data and read it in the counterparties that you have? And so sometimes your banks might ask you for ridiculous stuff. You have to make sure it's useful, and you have to make sure they know what to do with it once they have it. And so that's the kind of feedback that we give to the partners that we work with.
I want to zoom out. We started with one particular piece of legislation, the Genius Act, but what do you see as the mood? You sort of alluded to the debanking issue. I believe
It
you
drives
said
me crazy.
your brother is the chief of staff to JD Vance. Is that?
That is correct.
So that's a helpful touch point. Obviously, you've been in touch with regulators for a long time. I don't know what from Biden to Trump. How is the mood changing?
So a lot of segues there.
I'm
not sure where to go on this. I'm going to leave my family situation to the side. My family text thread is not always happy. But
does that mean you don't think this new administration is friendlier to what you're doing?
It depends on the issue. Let me go to that point because I think it's important for the people in this room. After the election, I feel like clients and even non-clients would come to us, say like, we're going to do this product. We're going to do it for 4 years. Then we're not going to get away with it. Like, what are you thinking? And I think
that's after Trump got elected. Like, we can do whatever we want. Let's go wild.
We can do whatever we want. And the idea that financial regulators have turned into the wild, wild west is wholesale inaccurate. Wholesale inaccurate. They have a job to do, and the people in these institutions are serious people who want to do their job, right? It doesn't mean that some people are problematic. Trust me, there are plenty of them. There are plenty of them at all of your companies too, right? Like, we always have the outliers of the person, who doesn't always take the right risk decision or, is overzealous on a particular topic because they got harmed by it. But overall, financial regulators are trying to do their job. And so there are always cycles where particular issues get amplified or not. And then I would say in the last administration, the Biden administration, I think there were two institutions that got politicized. One was the SEC around crypto. The other was the CFPB. CFPB has always been politicized, though, from its foundation. And so they have ebbed and flown around politics on various and sundry issues and enforcement actions. But in general, they also do some good, like some of the open banking rules. But in places like the OCC, the Fed, the FDIC, in general, they're really trying to do their job. Now, the places where the orientation has changed is around top-level approach to innovation, and the strategy around pursuing innovation, I think, has gotten a lot more open. And whether that's openness to chief innovation officers at some of these entities, outreach to actual industry participants, you do see that kind of orientation being more open. And I think that's where fintech will benefit from that type of orientation. But it definitely doesn't mean that it's turned into the wild, wild west around compliance. And if anything, I think we're entering a phase where the complexity of real-time money movement and multinational money movement has changed in such a way that regulators are trying to figure out risks that they've never seen before, because they're looking at fraud and AI risk on real-time money movement, trying to figure out whether they have to put friction back into the system, and they're trying to make sure they understand how. And AI is one of those places where they are really engaging industry participants, because AI is one of those things where they truly understand that they need AI industry companies in order to educate them, versus like crypto, where they felt like they had a good enough understanding over the last decade, where they were able to listen to industry participants from all different parts of the ecosystem and then feed back their own guidance. AI is still one of those things where it's so early, And it's so asymmetrically life-changing and product-changing and risk-changing that I don't feel like they have an understanding of it, but they at least appreciate that they need to reach out to the AI folks in the AI industry in order to grasp where the risks are coming from.
I mean, you see a lot of fintech activity overall. What's your read on sort of the number of new partnerships and activity that are sort of AI related versus sort of old guard businesses, or what are you seeing the most uptake in fintech right now?
I think everyone's trying to figure out what to do in crypto, and stablecoins as a payment device really is the biggest driver of that. I think that's been the most interesting dynamic in the last 4 months probably, and I think the last few weeks in particular has been very active on that, but I will go silent there and let you enjoy your next speaker, who has driven a lot of that noise in a great way.
So you think crypto and stablecoin more than AI is sort of what you're saying
Well,
there?
on AI and financial services, I don't feel like we've made very much progress beyond core fraud customer support use cases. Like, I don't see it changing underwriting yet. And machine learning is one of those things where I feel like it took regulators a long time to appreciate that the outcomes of machine learning were actually beneficial versus needing to backtest and prove every machine learning model in a fintech stack. And I do feel like we finally made great progress on that. Now the challenge of dealing with AI is the next set of issues to tackle. I have yet to see it in any jurisdiction used in a way that it is highly productive.
Is it more of a headache than help right now?
No, not at all. Like, I feel like everyone internally is using it for things like coding, their own team's efficiency, their own teams, their own internal team use cases, and maybe for more operational needs more than client-facing, non-customer support needs. And so that's where I touch on underwriting as the perfect example of what that looks like, which feels still highly undeveloped for financial services.
Is it amplifying fraud? Do you think you're seeing more fraud because of what's happening in artificial intelligence?
I don't know the answer to that, actually. I'd let our end clients talk about that more than me, because I think I'll give you a non-data driven answer. Statistically, like, are we seeing more AI driven fraud? So my suspicion is we're just starting to see it, but I don't know the answer. And I think real-time payments will probably be the biggest driver of it, because of the ability to withdraw significant amounts of capital with less friction.
You know, going back to an earlier part of our conversation, CFPB, less active, Wild West perception. Are there categories that you feel like you could do but won't do? Or like, how much do you think there's sort of banks need to self-regulate about categories that they participate in?
So even digital assets, I'll touch on that, because now that we're at this point where there has been a industry shift, I think all different kinds of companies, including banks, are looking at how they could participate in the ecosystem. And I worry a bit about that, because I think you have to have a particular skill in order to execute well against the digital asset ecosystem, because the risks embedded in the products are very different than the risks even of core money movement with remittance companies or using real-time payments. And I think the risks are just dramatically different. The velocity of the way money moves, both for client accounts as well as own corporate accounts, is very different. And so I feel like things like liquidity management, compliance management, if you don't have good automated systems and anomaly detection to manage that, I worry a bit about banks and how they might manage that and the risk associated with that. And it's not necessarily end-of-day money movement, it's intraday money movement that I worry about, where an asymmetry might impact a bank in real time in a way that they didn't expect or they don't have the tolerances to manage. And so I feel like crypto is one where I think more and more institutions are going to focus on it, and I would say make sure they're educated and have the teams available to manage it, which, just going back to debanking, that to me is one of the reasons why banks decided to debank financial institutions. They either didn't have the staff or team, they didn't have the concentration of clients to make the juice worth the squeeze, or they just chose not to pursue it until there was more clarity. But there wasn't like this overt nature
not Biden
of
bullying, not
No.
Biden administration
I
bullying.
mean, go look at all the public companies that do crypto and ask whether they have a bank account somewhere. And last I checked, as a public company, they just might have a bank account somewhere. And they just might have more than one bank account and potentially bonds, credit facilities, and other financial instruments that their treasury team helps them manage. So you start there, and then you go look at the large crypto companies that were operating and ask how they manage money if they don't have a bank account. It's like scratch your head and be logical. That doesn't mean that all of their counterparties weren't offboarded,
Right.
and there was a significant number of counterparties that were offboarded. And my observation, because we worked with a lot of them, we've been working in the digital asset space since we started the company, but my observation is some of these companies didn't want to do the compliance they needed to do. We chose not to onboard them. Some of them did it, but they did a half-baked job, and we worked with them to improve what they needed to do. And in some cases, we take small digital asset companies because we knew and trusted the people
Right.
that we worked with. So we were able to do that in a way because we knew their teams.
Right. We
But
are
they were
we are out
willing
of
to do it.
time. I could talk to you all day. Thank you so much. I really enjoyed it.
Thank you. Thank you. Good to see everyone.
All right. Thanks for coming back.